Hey everyone, my name is Addy, and I'm the owner of the Long Shot Idea website, and we run free webinars for options trading. Um, we call them masterclasses because we try and teach students how to be comfortable in the options trading space, how to trade with math and probability and high probability of success in this space, because a lot of the times I've seen retail traders and experienced traders basically buying options with like low probability of profit and success. But here we do things differently and we sell options instead of buying. So we um, we teach our students and our audience to how to create structures like credit spreads and how to manage those credit spreads, and how to be mechanical in this space, and make passive income consistently over years, over months, over weeks, whatever the time frame is. So if you've clicked on this video for the first time, if you're on my channel for the first time, I'm Addy. I've been trading options and selling options primarily for the last 10 years. And that's where my experience is. I can trade 10 to 12 strategies, defined risk, beginner level, intermediate level strategies. I've got experience trading strangles, credit spreads, and all kinds of butterflies, and you can name it, and I have done it in the past. So I'm gonna, but the idea of this video is to like take you through some basic structures, some basic stuff, so you can get the feel of the market. But if you're an intermediate trader, that's fine too. We have a few strategies for you, for your skill level, which we are trying to put together in a more structured cohort way, which is already live now. In that cohort, I train people on three or four of our very top high income. I wouldn't say high income, but I would say high probability strategies on a monthly and a weekly basis. So let's dive into this first. How to make passive income, monthly income consistently first. Small amount is okay in the options market, and then you can build yourself up for undefined risk strategy, which has an even higher percentage of profit, probability of making a profit, compared to these risk defined strategies, which includes selling an option and buying an option. But in the undefined risk market, we sell both sides of the market. We stay neutral, for example, strangles, and then we adjust those strangles based on whatever the market gives us. So, without wasting any more time, let me just take you through some of the theoretical part first. Like this morning, I sat down and I wanted to write down things that I struggled with 10 years ago, or even 5 years ago, or even 6, 7 years ago. I mean, it has always been a long journey to learn this market, a long journey to like figure out what's working and what has worked for me. And now is the time that I can give you this in a framework. We have our own framework of doing things. We primarily trade for futures options for leverage, for capital efficiency. For example, if we were to trade a stock position in credit spreads, uh, we can we can be three times more efficient with our capital if we trade the same thing in the futures options market. Yes, you don't get in the underlying single stocks in there, but you can get overall market exposures, and I can show you exactly how in our framework and how we do things. So, without wasting any more time, the top 10 common mistakes I've seen in myself and whatever I've seen in from my audience and from the feedback that I get is people trade without understanding the option Greeks. There's very little understanding around volatility and how it affects um, option prices, and then how volatility can be option sellers' best friend. When we sell in high IV environments, how leverage works. That's another big one. Number three, um, a lot of people do not have a trading plan. This all applies to me as well. This is coming from me sitting down and going back 10 years and then trying to figure out what did not work for me and how to change it and how to help people with similar problems and similar issues that I faced 10 years ago, 8 to 10, 12 years ago. People do not understand risk management. They will take a trade but then wouldn't know what to do with it when it goes wrong. So that's another problem, right? We here at Skills and the longshotidea.com, we our main focus is on risk management because we don't like to lose money on bad trades, and we don't spend good dollars, behind bad dollars or bad trades. So that's our main thing. We know how to adjust the trade if the market opportunity is still there. Otherwise, we just move on. We redeploy capital somewhere else. If you think the opportunity is gone away in this market, or in a particular underlying market, uh, when I say opportunity, I mean implied volatility. If the volatility is not there for us to sell, we move on, we take a position somewhere else. Okay, another big one is number six, chasing big moves. That's what I was doing too. I was just following the herd. I was just going after like out of the money options. People were like giving me some tips here and there, and then those are just like lottery tickets. The chance of that option making money for you is like very small, compared to what you can do with selling options. And that's what my aim is, to like instill in you or convince you to look at this from a different lens, that buying is not always good in the options market, selling is always better. And it can make you good consistent profits month after month if you are a good seller of the option. Now again, selling options come with their own risks, so we need to know how to manage that risk, how to roll the adjust, how to roll the trade, how to adjust the trade, and how to like be mechanical with the trade, in the long term. People also don't understand commissions and fee. That's another big one. There's a lot of commission that gets eaten up. A lot of your profits get eaten up through commissions and fee on these trading platforms, on your leverage and your margin fee. So ignoring that is not a good idea for your overall P&L, over your returns in the portfolio. The last two are basically, um, falling for the sure thing tips, like whatever tips you're getting from wherever, you just take those on and then you take a position on it. That's not a good idea. Assignment and expiration risk. Yes, on the long side, you don't have this risk because you pay the debit, you move on. But on the short side, you do have assignment risk, very little, very small assignment risk. Me trading in the last 10 years, I've only been assigned once. So we know how to manage the assignment risk. We know to how not to be very, very close to expiration cycles, because it's not just about assignment. It's about, a volatility of the P&L. We don't like to be too close to expiration because that's when the option prices are like moving around too much. There's a gamma risk, for short sellers, for sellers like us, and therefore we try to avoid that, and then we go into the next cycle, next available 45, 30, 35 to 45-day cycle. So, okay, going through this now, the next part of this video is to, find the solutions of these problems. And like I said, we talk about all these problems and all these solutions in our webinar, in our trading challenge, which is a 5-day trading challenge. Let me show you exactly what we cover, so you know what I'm talking about. This is a challenge that's happening in 35 days. It's $97, really upfront with that, no hidden charges. That's it, flat fee. And if you don't like it, there's a full risk disclosure here on your return policy. You can get the money back if you don't like it. Just drop me an email. But you got to show up for the 5 days of video calls. Anyway, this is what we will cover in this day by day. We will go through some fundamental building, foundational building stuff on day one. We'll set up a trade. We'll put a trade on, live trade. Then we'll talk about some income generating strategies, credit spreads, which is our bread and butter, and this is what we do the best, in the best way. We find the best markets, best setups, entry points, and how to exit, and when to exit. That's the main one too. And then how to manage the risk. That's another, like I said, it's a really important topic for us, how to manage the risk. And then we'll talk about some advanced tactics, and I'll talk about some undefined risk strategies like strangles and straddles, and then some butterfly strategies which can be done undefined and which can be done defined risk as well. So without wasting any more time, let's go through the platform. I'll show you three of our most popular strategies, the one that we love the most, here at Skilled, and at the Long Short Idea website. First of all, let's say you're trying to. I This is my paper trading account, so I already hold 100 shares. If you are just getting into this market, I recommend opening up a paper trading account, get some paper dollars here, and then start buying some shares. I bought 100 Apple shares just to because I was going through another webinar and I needed to show how the cover calls work. But anyway, The cost basis of the shares when I bought it, I need to go through here and show you the trade price was $200. Let's say flat 200, right? Now, flat 200 means I have 100 shares here, just one lot, which means I can I can sell one call option on this because I have 100 shares. Now, how will I do that? Okay, 45, 42 days out, that's a sweet spot. Anywhere between 40 and 50 days, that's a good time horizon, time period. Look at the chart for implied volatility. Um, the implied vol chart is not coming up here, but the volume chart is here. On the downside, there's a lot of volume here, and then I can get rid of these. Okay, so I need to bring the implied volatility chart here, which I can show you here by bringing implied vol. Oh, wrong one. Okay, implied vol here. So, first thing you look at, yes, implied vol is slightly elevated right now. Otherwise, it is usually very depressed, around 13, 14. It's around 20-ish in Apple. It's a good time. If I were holding 100 shares of Apple here, I would go into this cycle and I will select a 17 to 20 delta call option. Right now, there's a difference. So look at the difference between 23 delta and 16 delta here, right? One is a strike 220. The other one is strike 225. Now I would sell between the two. The way I would decide a strike to sell a call option on is where am I comfortable giving these shares away? Um, am I comfortable giving these shares away at 220 or 225? Currently, the market is trading at 204. Okay, it shows here 204. So you can take a $15 upside and if you're willing to give the shares away at 220, I would right click and I will sell this option. To be honest, if I had this position on, this is what I would do. I would sell a 23 delta call option because the premium is almost $100 more. Look at this. 231 versus 145. That's the premium difference. Almost $100 here. So I would sell this one and I would manage the risk. When I say manage the risk, meaning if it gets too close to me, and remember, call options are sold when the market moves up. That's when you get the best bang for your buck. Meaning, whenever you have to sell into the strength of the market. So when the market goes up, you have to sell the calls. When the market goes down, you sell the puts. And the selling the put side has worked 80% of the time in the last 20 years. You can look at the studies. I have something opened up here. The reason I say that is because look at this. I ran SPY data from um, for the last 15 years, I think here, and I wanted to see how much what has SPY or the S&P 500 index has done in terms of its standard deviation, meaning how far has it moved from its mean. So mean is the middle line where the returns fall in a normal standard distribution, and then you have standard deviation from it, meaning how much does it deviate from its mean level. First step was to calculate the mean. So I downloaded the price data, the close data from Yahoo Finance. Yahoo Finance is all free. You can just go down and do it. It ends on 4/15/2025. So maybe a month and a half ago. And then I did just a daily calculation of returns on this. Okay, based on those returns, I calculated the mean. What is the daily average mean value of these returns? Meaning, how much does this stock moves on a daily basis, on average? Okay, so it moves 4 basis points overall. So if you multiply this number by the price, you will know the daily average dollar move on this. Anyway, that's not important. The standard deviation is then just a standard deviation formula on the daily returns. This is the daily standard deviation of SPY in the last however many years this data goes for. I think maybe 15 years. Starts from 2005, ends in 2025. Okay, a little over 20 years. Okay, now how many times has the daily return been within one standard deviation of it? Meaning 81% of the time, the SPY return has been within one standard deviation of its mean in the last 20 years. What does that mean for us? That means because when we sell options, we sell one standard deviation out. Okay, this 16 delta will give you one standard deviation out completely. Now look at this. If I take this into the um, if I take this into the analyze tab and look at the number. Oh, first of all, first thing you need to do on the analyze tab is change the dates here. Look at this date. You have to change this to make the charts line up on both sides. Okay, so here's the number. Here are the numbers. If you were to sell this 16 delta call option on your position 42 days out from now, I cannot see. It's a little blurry. Okay, so you have a. Oh, you need to take this stop position out. Okay, so that's what I was thinking. Why is it going in the other direction? Anyway, the short call itself is over. Let's see what the number is. Probability of profit is what I'm talking about. The gray area is a one standard deviation move here. This is how the platform is set up. You can look at this here, probability range. You can increase this range, and your gray area will just keep on increasing, or you can just set it up to one standard deviation. And one standard deviation means we sell options outside of this one standard deviation range on both sides if we were to sell both sides. Here we're only selling the call side. So on the call side, one standard deviation move goes up to 184 or whatnot. So the current price is 204. We are selling this at 225 on the upside. So that's where we are going on the call side. Okay. So we have a 80% chance that this call option will be profitable for us, because based on historical data, that's what's happened in the last 20 years. You can go back 30 years, check whatever numbers you want to check. But one standard deviation move is where you get the good amount of premium to collect if the volatility is high. If the volatility is low, medium, whatever, you can still collect good amount of money and then manage the risk, take the profits at 25, 30% of the max profit, and then manage the trade like that. But anyway, the point to show you was where would I sell if I had 100 shares? And this is how the cover call works. So cover call is a long delta strategy, meaning you're still bullish in the market, but you are capping your upside at the strike level wherever you're selling it, plus the premium. Okay. So at 225, after that, your profit on Apple stock will be capped. That's what cover call is. Um, in order to manage the risk, you have to be able to roll the call option out if it breaches your short strike and you still don't want to give the stock away. That's why I said in the beginning, sell it where you are comfortable giving the stock away. If you're not, then you have to keep rolling it up. Okay, you'll still make money from wherever the stock is right now up to wherever it goes up to your short strike, and then after that you will be plateaued at that flat line. But if you still don't want to give the stock away, you think there's still bullish momentum in the stock, just close the current call out and then move it out in the next cycle. Anyway, that's one way of doing it. Or you can just close it out completely and just be done with it. But that's not how I do. I sell call options to make money on this, like passive income, like I talked about. The idea is to like make premium, keep the premium, and keep doing this, rinse and repeat this 4 or 5 times a year. Annualize this number, 25, 30% a year just on this trade. Okay, that's the idea. The next one, really want to be quick here. If I were to sell a short option, a short put option to acquire some shares, this is what I would have done. Would have gone on the 15-20 delta strike again. Like I would have chosen this 20 delta strike at 190. The days to expiration should have would be 42, totally fine, sweet spot. Okay, and then I would have sold a single. And when you sell a short put, that means you will hold enough cash in your account. So in case if this is assigned to you, you can bear the cost of buying the shares. That's the whole idea. Now look at if I were to sell, look, the buying power in my account is $18,000, right? Because this is not the true reflection of what it will be charged when I will be assigned here. But this is, you need this much money to actually initiate the position. But this is only less here because I already have positions in Apple, and maybe they are portfolio margining me right now, cross margining. But if you were to sell this position, you would be charged based on 100 shares if you were to be assigned at that strike, minus your premium. So whatever premium you collect, you're collecting $2 and something. The strike is 190 minus that 197, sorry, 187 or something times by 100 is what you will be charged. I have other videos on. I just recently did a wheel strategy video. Take a look at that. That's exactly what the wheel strategy is. You sell a put option, then you sell a call option when you get assigned. Okay. Um, anyway, same criteria here. 70 to 80% probability of profit. Keep doing this, and then get assigned. Once you're assigned, you don't want to keep the shares. You sell the call. But if you do want to keep the shares, you buy and hold basically. The next one is I wanted to show you guys is the credit spread. So today the markets have been up quite a bit. It's always very risky to sell call spreads in major indices like S&P 500 because there's such a positive drift in this market. Meaning I've been hurt more on the call side of option selling in the major indices versus the put side because there's such a positive drift. Now today the job numbers came out. They looked like 139,000 jobs added in May, and look at the market. It's up 68 points in the E-mini S&P 500 futures. Now, what would I do in this market? I wouldn't touch this even with the barge pole here because on the call side at least, I would not. And I would not even touch it on the put side because the market is already up. You sell puts when the market is down. You sell calls when the market is up. But would I sell calls here? I would not because again, there's a higher probability of my calls breaching in the major indices than in any other market. So what would I select? But I will just show you the trade. If we were to do anything here, this is how I would do it. 42 days out, okay? I'm selling a put spread. I am more comfortable selling put spreads in major indices than than what my comfort level is selling calls. I keep saying that, but that's the truth. I am not very comfortable selling calls in major indices. I don't like it because look, you get a day like this when it's up 67 points and it's very close to your break even point. And I don't like that. Anyway, so that's why I sell puts. When do I sell puts? When the market goes down. Not a day like this when the markets are up. Okay? So that's the first thing. If I were to do anything here today, I would have sold it at 20 delta. Well, 18 to be honest. So 57.25 would have been my short strike. I'll right click and I'll sell a vertical. I want to show you a couple of different strategies that you could do in this in this market. Anyway, 25 points out. Let's take it to the analyze tab. Let's go through a strangle example as well, along with this credit spread. So, okay, move this up. Look how nicely this is settled within your gray area, meaning the underlying is supposed to stay within this gray area between now and expiration cycle. Okay, that's the whole idea. And if you also want to, I cannot get rid of these gadgets. Why is this thing here? I don't really need this here, so I can bring this down. Okay, and I don't even need the volume. I don't really use volume, to be honest. I don't really use any indicators. It's just price action that I need. But I was trying to bring up the portfolio probability of expiring cone. That's the one. I like this chart. I like this thing. So look, it based on current volatility and a 30-day cycle. Now look at these red vertical broken dotted lines. These are 30-day expiration cycles. So you can match these dates here in the corner. And I also need a pen to show you there. So you can match these dates here with um, when you go back to the trade tab and then look at the expiration cycles, which are 30 days out, the monthlies. Go to these gray ones and you will match the dates over there. That's one way of looking at it. Anyway, the idea was to show you where the underlying is supposed to trade between now and the end of the cycle. That's where it's supposed to trade. 6523 or 6623. I messed up the number. 623. Oh, why is it showing yes? That's fine. Even if it does, that's okay. Okay, ES is here. So I do have implied volatility here. ES is supposed to go up to 6,200 and down towards 5,800. Now let's try and, once we're done with the credit spread, I want to show you the strangle trade based on these numbers. Okay, based on these numbers. These are one standard deviation number based on 30 days out, wherever the cycle ends. These are the cycle dates. 620. That's what I see. 620. That is correct. So I should be selling it for 718 cycle, right? Where the number is 6360 and 5732. Okay. Back to our short put example, we are collecting $125 in total because 250 here, you need to just divide this number by half or by two to get to your actual dollar amount. So divide this by two. Okay. Sorry, I covered it, but also hover over this line and keep an eye on this number, probability of profit, when I change the dates here in the middle, on the bottom here. This buying power effect is probably not true because let's try and put this trade in. This is not how much money you put down. You put down half of that or a lot less. The max loss is basically this line. So when I hover over this, keep an eye on this, basically these numbers here. Okay, so let's try that. Hover 60. The max profit is 137 because now this number is changed to 275. Max profit is 1100, but we never go to max profit. Okay, and these are the things I want. Okay, one more thing: the probability of profit and then the Greeks. You need to keep an eye on these Greeks. So right now we have some positive delta, which is good. We have positive theta, which is always very good, and as option sellers, that's what we bank on, right? This is our daily paycheck, and then we have short Vega because volatility has ticked down today, so therefore we are expecting this volatility to keep coming down, and then we are expecting the market to either stay within this range, meaning it stay flat or go up a little bit, right? So the underlying is here right now, 66,066 or 6,016. Is that the right one? 6,016. No, that's 60. I need to change the slices here to plus 10 minus 10. And I need to bring it back to break even. Okay, look at this number. This is what I like, 84%. But, okay, 84% probability of profit, meaning you have an 84% chance to like make money in this trade, meaning your underlying will stay within this gray range. And if it does that, you will make money. That's what this number is showing. Okay. The current underlying market is 6,000. Let's say call it 6,000 flat, which is here, this marker. Okay. This marker here, I just overran it. So this small thing is your underlying ticker, meaning from here on, it can either go down to here and you will still make money based on one standard deviation, or from here, you can even go wherever. Wherever it goes after this point, you will make money anyway. Okay. On the upside, you will make money, but on the downside is where you need protection. What else? I've showed you the Greeks. I've showed this. That's it. Oh, I need to show you the buying power effect. Let's try and put this trade in. The buying power is now 451. So that $700, we don't need to look at that, but this is the buying power. Look at this line. Okay, and then these are the commissions you will pay. 450. Actually, a note there. The overall commissions are slightly higher than that. For me, it's a $7 trade to get in for a two-legged spread, and it's $7 to get out for a two-legged spread, meaning each leg costs me about $3 and something. Okay, so just be mindful of that. Yes, futures options market is slightly more expensive than the stock market or ETF market or any other market, but it gives you more leverage, meaning for the same amount of money, you can have at least two or three trades compared to one trade in your other market, okay, in the stock or the ETF. Okay, this is done. Next one. Let's talk about some strangle trades here. 42 days out, perfect. I like this number. I wanted to show you one more thing. So these are the two important things I look at: open interest and volume. But look, today's volume, volume numbers are really dull. Small amounts, not much going on in the markets. But look, the open interest needs to be in thousands, which is what it is for ES. ES, E-mini, S&P 500 futures are really liquid. So you don't need to worry about liquidity in this market. It's very liquid. And so are your other S&P 500 markets. Same thing. Same thing applies to them as well. Okay, this is your 19.05% is the implied volatility for this cycle. And this is the implied volatility range, 318 points from here. $318 actually. Okay. So now we need to cover at least I would try and cover at least $320. A $320 move on both sides. So Again, simple idea for a strangle. I would sell it at 18 delta here, 57.25. Go right click, sell, strangle. Okay. So the first strike is already set up for you, 57.25, because that's where you selected, right? The other one, I need to bring this back to one. The other one is, again, you have to select. If I was me, if this was me, I would select the same delta, right? So that I'm delta flat. That's the whole idea for it. But you can be up or down here depending on what your, what your outlook is. So if your outlook is really bullish, I would sell a put um, option a further up on the money here. So closer to the market, meaning you will collect more positive delta than you will have the negative side. And I can show you that. So if you were to move your put side up to here, 25 delta, 58.50, um, let's go and find 58.50. Where is it? This is for people who have a bullish. If I were to take this trade, I would skew it up a little bit on the bullish side. There is a lot of bullishness in the market, but market is already up 70 points today. I can see it here. Will it keep on moving? I think it will. That's what it does. It does come down a little bit, but then it keeps going up. So that's what the idea is. Okay, and on the downside, I would keep it at 18 or 20 delta, which is 6,300. So on the call side, I would select 6,300. Let's take it out to 6,300. Now let's see how much money are we collecting? $81. Okay, so you need to divide that by two to get the actual dollar amount. So remember that. This is how a strangle trade is set up. 60% probability of profit. That's fine because you're selling both sides. Okay, and because you're selling one side closer to the money than the other, that's why this number is lower. If you keep both sides at 18 delta, this number will go up to 75, above 70 basically. Even above 75, I think. You want to check that? You can do this at 5,700. Let's try that. Let's try the put side on 57.25. And then go recenter the break evens. Now look, this has gone up to 66, right? Now and then if you move your call side up a little bit more, we're selling it at 20. Let's move it up to 16 delta somewhere. Take it at 63.50. You're still collecting $55 here, man. Like 55 points, which is divided by two, is like $25. Total profit is 2,700. Okay, and there will be a big buying power effect here because these are naked options. You're selling both sides as naked. Um, and the risk is undefined, and therefore you will be charged more money to hold this position. So if you confirm and send, look, it's a $15,000. Um, it's a big contract to sell naked. That's why we stay within $300 to $400 buying power effect, which is a credit spread, um, and and that's how we go. That's the name of the game for us. For the next part, I want to show you the Greeks on this strangle trade. Now the Greeks are completely flat. This is not these are not much. These are not open Greeks. You have only two deltas here. Theta, pretty good theta number, 90. Short vol, great number here. And then if you were to skew this to the, on the positive side, on the bullish side, I would sell a slightly, in the money, not in the money, but towards closer to the money strike, which is 58.25, let's say. And therefore, then you will see your delta go up because now you're selling a bigger positive delta than what you're collecting on the call side. And therefore, that's why you have a positive delta position here. And if that's what your market outlook is, this is how I would have trade. I would trade this. Now the question is, how do you manage this thing? It's a big beast here, right? You're putting down $50,000 to collect 2,700. The max that we will make out of this is like from 2,700. I will take maybe 40%. So I'll take home $1,100, and I'm still putting down 15,000, which can go up to 20,000 because it's all spend margining, and my overall return will then be 5.5% for this particular trade. Now, if you can do this trade 5 times a year, annualize this number, and that's what your actual return is on the strangles. But what we do on the credit spread side, we do the same thing. We put down, we collect $150, not points. So we collect three points, 3 index points for $150. We take home about $80 from it. So I take home $80 from, and then we only put down 350 most of the time to trade. So that's what I return. That's what we do. 22, anywhere between 15 to 25% return on each trade for us. And we do that in all futures options markets. So I've showed you a couple of different strategies today. These are all passive income strategies. You have to set it, let it, and forget it kind of thing. Like you have to let it work its way out or its way to profitability. And this is how you do it. Passive income. There's a nice ebook coming out from us, which covers 14 different strategies that we usually run. The top five are always going to be, CSP, cover calls, credit spreads, iron condors, butterflies, and some defined risk, some undefined risk. But I cover a lot of the other strategies which people may be interested in and show them how to actually work on them and trade those. So hope you like the video. If you do, and if you did, please sign up for my for the channel, and then I'll put the webinar link, and then the main trading challenge link where we go really deep into these strategies on a live basis. This is a paper trading account, but I go live and I set the trades up, and then we manage those trades and we look at them on a daily basis. I cannot promise you that I will make you the best trader in 5 days. That's not how the world works. It took me 10 years to gain all this knowledge. It's practice. It's the number of occurrences. It's about how much time do you give to this market to learn, and we try to cover all those things in our main challenge. So hope to see you there. See you next time. Thank you very much.